Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 3. Mr. A is interested to invest 1 lakh in the securities market. He selected two securities B and D for this purpose. The risk return profile of these securities are as follows: security B and D, and then the risk, which is nothing but the standard deviation, 10% and 18%, and the expected return is given as 12% and 20%. Coefficient of correlation between B and D is given. So as we have seen in our previous videos, coefficient of correlation is nothing but how B and D are related in terms of movement. Let's say if B is moving 1 point or B is moving 1% upwards, D is moving 0.15 times that 1% upwards. So we can say if the correlation is 1, then both are moving towards in the same direction, upward movement. If the correlation is -1, that signifies if B is moving upward, then D is moving downwards to that same percentage. If the correlation is 0, then it is not related itself. Okay, so they have given the coefficient of correlation between B and D is 0.15. Now you are required to calculate the portfolio return of the following portfolios of B and D to be considered by A for his investment. He is investing 1 lakh in the securities market, so and they have given the possibilities. So if he is investing 100% investment in B only, then whatever risk for B will be the same portfolio risk also, and whatever the expected return in the security B, that will be the same expected return of portfolio, as there is only one security. In the second possibility, 50% of fund in B and 50% of fund in D. So we have to use the standard deviation approach for two assets, which will be this formula. We cannot directly take the weight, so we might have a question that why can't I take 50% of 12 and then 50% of 20 and directly calculate the return or directly take the risk. It doesn't work that way, because this standard deviation is the variability of the securities, and as we already know, when we go for diversification, the risk of the security reduces because of some unsystematic risk. The unsystematic risk can be nullified by diversification when we invest in different securities. The same case goes with here. If we are investing in multiple securities, even though the security has a risk which contains systematic and unsystematic, but if two different securities are in a portfolio, and the portfolio's risk will be reduced, so we can't directly take the weighted average of the risks here. So we have to use the formula here, which is, for simplicity's sake, we can use this formula: a plus b the whole square equal to a square plus b square plus 2ab. The same way, a is nothing but b in our case, and b is nothing but d in our case. So a, we have to take the weights, right? A is invested in 50% proportion, so 0.5 multiplied by the risk of B. I'll just change the formula for understanding sake. Okay, and here there is a catch. So it is not just 2BD, the correlation also has to be multiplied here at the end. So 2 into B into D into the correlation of B and D. They have already given coefficient of correlation. Okay, now going further, as substituting in the formula, the weight of B is 50% in the second possibility, same D also 50%. So 0.5 multiplied by the 12%, 0.5 multiplied by the 10%, the whole square, or else 0.5 square, 10 square, then 0.5 square, then 18 square, then 2 into 0.5 into 10, 0.5 into 18 into the correlation. So this will be the portion of B, and this will be the portion of D, and this will be the correlation of BD. This is 2, and this is that B portion, B square. This is the D square portion. Since weight is multiplied, anyway the mathematical rule, the weight of B multiplied by standard deviation of B, the whole square, is nothing but weight square multiplied by standard deviation square. Same thing they have taken. The expected return, we can take the weighted average, as it is not the risk, it is the return which we are getting from the same. So the expected return of the portfolio will be nothing but the simple weighted average, but the risk will not be the same case. We have to apply in this formula to arrive at the risk. As we can see, the risk also is reduced if we directly take the weighted average risk in this case. It will come up to 28 divided by 2, which will be 14. But as we can see, the standard deviation of portfolio, which is the risk of portfolio, is 10.93 only. It is not 14. This is because of the diversification of the securities in the portfolio. So when we diversify the securities in a portfolio, the unsystematic risk portion of the total risk will reduce. As now we can clearly see that difference. Okay, now the third possibility is 75% in B and 25% in D. The expected return will be just a weighted average. The standard deviation we have to apply in the same formula which we have done here, so which is coming up to 9.31, and in case of D, 100% in D only. So since only one return is there, risk and expected return will be same for the possibility. Now if we compare all the possibilities, they are asking the last point, also indicate that which portfolio is best for him from risk as well as return point of view. They are asking risk as well as return point of view. If we compare based on return, then the fourth possibility is giving the most return, which is nothing but investing only in D. But if we compare in risk perspective, the risk is less in case of third possibility, which is nothing but the 75% of B and then 25% of D. That's it. Thank you.